right here, I have some slides that I want to go through and pretty much go through and take a look and allow you guys to see. So when you take a look at, market economies, and this is going to kind of give you guys an idea of some of the things that I look at really from a standpoint of really taking a look over asset allocation. So I want to talk about asset allocation tonight. This is first is conservative, and I'm going to break each one of these down. So if you've been conservative with your asset allocation, you've seen an annualized return of about 6.1%. 6.1%. The growth of 100,000 over the past 20 years. If you've been conservative, and this is just an average, this isn't necessarily just the highest amount, but on the average, you've grown that to about 317,000 for every $100,000 that you would have invested. Obviously, people have been investing heavy. You guys get the returns, multi-million-dollar type returns, literally by just having invested at minimum of $300,000 over a 20-year period. Now, that's being conservative. You'll see that a lot of this was a combination of fixed income and also equity. So a fixed income and equity. If we take it down to really aggressive or moderately aggressive, you see that this pie chart gets a little bit bigger, and you see that a lot of that is due obviously to aggressiveness in actually holding equities. So I want everyone to kind of start paying attention and really looking at your risk tolerance. If you're someone who's not really comfortable with like major drawbacks in the market and, seeing probably major pullbacks, this aggressive type portfolio would probably be someone who has a lot of growth stocks. So obviously when the markets are increasing a lot more higher, a lot of times those growth stocks do generate higher returns. Now, people with conservative or moderately conservative portfolios are kind of split to where they have a little bit of their money in stocks, but they also may have their money in other things. And we talk about fixed income, we can even talk about things like real estate, multifamily properties, etc. So I want everyone to kind of really start to rationalize and factor in, where do you want to really belong? What category? And everyone has different risk tolerance. Obviously, a lot of times they recommend a lot of younger people could be more comfortable being here in this aggressive because they have more time. Obviously, people a little bit older, you might want to be moderate or a little bit moderate conservative or even fully conservative because you're really trying to protect as much downside as possible because you're nearing ages where you potentially want to retire early, all of those different things. And you need things that are kind of more stable and not that extra volatile. So this kind of gives you an idea of moderate is kind of in the middle where you have some cash, and notice that, this dark spot right here is the amount of cash. So this is good. When I always talk about cash as a position, it's always good to have cash on the side. You don't want to have all your money invested, and you don't want to have all your money tied up. So making sure that you have cash on the side. What I want to show you guys is the asset class versus performance. So a lot of times when you take a look here, we have here higher volatility on this side of our graph, and then we have higher return on this side of our graph. Usually, a lot of times, you see the higher volatility, typically sometimes the lower type returns, where sometimes you see a little bit of the slower volatility is usually where you start to see a little bit of the better returns from a percentage standpoint. Obviously, in times when people are more aggressively looking at stocks, you see that sometimes the volatility can lead to a higher return. But during this time when people are a lot more conservative, those higher volatility plays get dropped off. How many people by a yes in the chat have seen their growth stocks probably decline 50 to 60% in the past, 3 to 6 months, but you probably seen something like Apple or Microsoft probably not even sneeze 10%. Yep. All right. So this is another way. So I have here this asset class versus risk performance. Now, a couple more. I got a lot of slides here tonight, so a lot of information for you guys. So I get these slides pretty much a lot of times weekly. So I like to give you guys an example. This is for a lot of people that ask, Lawrence, where you really looking and getting your economic data. I'm taking you guys through this process here. But also taking a look back, history of U.S. bull market and bear market cycles. So you guys can kind of get a kind of process of seeing that, to be quite honest with you, this highlighted here, this bear market is really small if we're really being honest. And I'm taking you guys all the way back to pretty much 1932. And so you see that obviously here during the Great Depression, we had a 33-month period where the markets went down 86%. Obviously during the Great Depression, for those that don't know what was the cause of the Great Depression, it was actually the complete opposite of what we're dealing with now. It was deflation. So deflation is where you start to have you could have the same amount of money, but instead maybe you took that $100 and that $100 buys you what used to buy you now what used to buy and cost about $150. You can take $100 and be able to buy that. So we saw a decrease in prices of goods and services of like 34% in that time period. And we were in a 33-month downtrend, obviously World War II as well too. Also here, we were in a 61-month, so 5-year downtrend, negative 60%. But you notice as time has really went along, some of the length of these downtrends have really been minimal and small. You saw here 1950s, 37 month. Saw here 1962 and 1963, 14 months down, 22%. So really when we define a bear market, I'm glad they said this, bear markets are a normal part of stock investing. While they have varied in lengths, the stock market has historically recovered from each bear market, and we've seen that. But if we start to look at the in-between months, think about it. You had 60 months of 323% return. And think about that. That's just on the actual indices, overall indices. We're not even factoring in the fact of outside of just looking at the indices, if we factor in as well the stocks that grew during this time period too. If we go here to the 80s and we take a look after Black Monday, and you saw that in the mid 80s, if you studied history of the markets and you start to take a look at what happened during Black Monday, you see this 27% drop, 34% drop. You saw a 3-month drop in 1995 and think about that. That's only 3 months. So 3 months and then boom, 3 months downtrend sets you up really for a major uptrend. Then you came down again, 2007 financial crisis, and then boom, we saw a nice uptrend again, 59 months. So if we really think about it, for the most part, you've at least seen, for the most part, a lot of times the markets are moving up at least a minimum of 50 to 60 months at minimum. We've seen more, but at least 50 to 60 months in a row. And so this is why you really want to be invested in the markets, and investing in the markets when there's a drought and where you start to see that, prices are collapsing and caving in, and understanding that some of the companies that you probably looking to acquire, some of the ETFs, some of the longer term investments, the best time to buy is not when something is going to the heavens. That's the best time to buy. So the best time to buy, the question that I always get, when's the best time to buy, is when something's not going to the heavens anymore. And the thing is that right now, a lot of people are probably going to get discouraged. A lot of people are like, oh, boom, like it's not happening right now. It's not supposed to always happen all the time. And that's kind of what I want people to really start to think about, is that, think about it. If the market was always going to an all-time high, when would you ever be able to get in? I want people to really sit back and really think about that. If the market was always making new all-time highs, when would you ever be able to get a position in? I will tell people that. And so this kind of puts things into a perspective for you to really see it laid out. And you see that I call these type downtrends, I call these market sneezes. These are all sneezes. This is just the market sneezing. And so I want people to look at, when you start to see, the markets move down. I know the NASDAQ is still in a bear market. Still in a correction, almost made it to a bear market. NASDAQ is only down about 12% from highs. When you're taking a look, correction is only a 10% decline or more. A bear market is when it declines 20%. No indexes have even hit a bear market yet. Could that potentially happen? We'll see. But I will say this, if we do go down 20%, that is a opportune time based upon history that has showed that if you are a buyer during that 20%, that 25% downtrend, historically, hey, maybe it doesn't come back day one, obviously. But if you're a buyer during that time period, in these time periods of turmoil, you will be rewarded at a later date.